In the energy patch today, large swings in the crude oil markets. It is holiday trading. Even though we had a full session today in everything but the interest rates, commodities were open, equities were open. The swings in crude oil were a little unreasonable. Keep in mind, they were on low volume. Crude oil started higher, went lower, went negative by over 1%, and then closed up 1.24%. On its highs, we were up 3% on crude oil. WTI was at 46.53, closed about 45.89, getting up in toward the middle area of those high prices in toward the end of the day. Quite a bit of it was on perceived demand growth. Over the weekend, President Trump tweeted that they made big progress in a phone call with President Xi Jinping. Now, this gave equities a little bit of a boost and gave crude oil a boost on the idea of perceived demand growth. Again, the U.S.-China trade war is still the major economic conversation piece. All of the warnings we've seen, both in the oil patch and equities, have been based off of the trade war. So the oil patch rallied a little bit based off of potentially a deal coming forward. But we've all seen this before. We get a little bit of hope, then we get some negative news, then we get some hope. And again, over holiday trading, you're not seeing the full force of the market to bear on the crude oil patch. So I guess that positive move we've seen, it has to be looked at as going into the new year, 8% off the lows now to the upside after a 43% move from the high to low. I mean, I guess it can still be taken as positive. We need to wait until the new year. Now, going into this particular week, it is a critical week for crude oil because the OPEC production cuts are scheduled to begin January 1st. Now, compliance has actually been much more successful than anecdotal stories would have you believe. When you talk about the compliance to last production cut, it averaged about 116%. So it was a little bit more than was expected. OPEC has talked already about being more transparent and starting off the production cuts in a more aggressive way than they had in the past. But the perception now, because of the trade wars and the trade tensions, have been that demand will be lower, absorbing this production cut and not really taking care of the crude oil surplus, which has been part of the reason crude has continued to go down. Earlier last night, we got a decent piece of Chinese data where we got their ISM a little higher than expected at 56%. Last month was 50. So the 50 is that sort of fulcrum between expansion and contraction. We got well above the expansion level now at 56%. So looking at that, you could potentially see some positives and an extension of crude oil, but we have a fresh batch of API, EIA, and rig counts. Which, by the way, on Friday, rig counts were up by 2. First time we've seen an increase there in 3 weeks. So all of this data this particular week is critical because those production cuts actually start this week. You'll start to see rhetoric about how the compliance is doing later this week and then early into next week. So keep an eye on that as you watch crude oil.